Okay, hello everyone and welcome today to our webinar and special presentation from Craig James, Chief Economist of CommSec. Can everyone hear me? Please nod if you can. Great, fantastic, awesome, thank you. The technology is working. We'll have everyone please mute your microphones please if you're not participating, because we don't have any background noise. I'll just give it a few moments and stop talking while that occurs. Okay, thank you. Fantastic. Sounds like that lawnmower has been muted, which is great. For those of you that don't know me, my name is Patrick Barry and I'm Head of Wealth at Partners Wealth Group. And thank you for your attendance today in this special webinar. We're very excited to have Craig James, Chief Economist of CommSec, presenting and providing a special COVID economic update. And also I'll be presenting us on 10 little known strategies that most Australians should be adopted in relation to their wealth curation and wealth protection. I would like to extend my welcome to everyone who's attending today. We've got people dialing in from Sydney, Melbourne, Perth, and also regional Victoria. So thank you for taking the time today. Well, we want to extend our wishes. I hope everyone is coping okay with the current COVID restrictions, especially in Victoria and for those in other states that have been impacted. If someone had told me 8 months ago that we'd be holding an economic update via a webinar, I wouldn't have believed them. So over here in Victoria, we've been working home for the last 7 months. So it's actually made us all innovate to continue to work, which has been interesting. And today is the first time in 7 months I've put on a tie, so it was a bit of a challenge. I'd forgotten how to do that. We encourage questions to be coming from the floor, please. So you'll see with this WebEx here, there's an ability for you to type questions. Please type questions during the presentations, and at the end we'll have an opportunity to actually ask those questions to Craig or myself at the end of our presentations. So I'll just share my screen now and move to share my screen so we can actually see the slideshow. I'll start my presentation. So so today I'll just be going through, it was going to be 10 important strategies that everyone should know. We decided to throw an extra one in there and make it 11. And these are sort of financial planning strategies that most people overlook. And we're all trying to solve the common problem of having enough money in retirement and making sure that we have a retirement income stream that lasts our lifetime. So before I get started, I just wanted to make sure everyone aware that important information today is really general information for everyone just to look at. We haven't taken into consideration your personal goals, objectives. So please don't go out and make any decisions financially around this information. It's just for a general purpose for you to get some information. If you do want to seek further information, please contact your accountant or your financial advisor who can actually sit down with you and work through your personal circumstances. So before we get started, I'd just like to give you a little bit of background on who Partners Wealth Group are, because most of you that have joined today have joined through your relationship with your accountant, who we have trusted partnerships with. So we're one of Australia's leading diversified financial services businesses, focusing on working with accountants to provide services to their clients, such as yourself, in relation to financial planning, wealth, legal lending, and SMSF expertise. The business was established in 2003 with 3 partners. We now have 85 staff across three locations, being Sydney, Perth and Melbourne, and a business that has strong corporate governance, which is really important for us when we're working with our accounting partners to deliver financial solutions to their clients and to our accountants. So what makes us different? One thing that we really have focused on in our business is working closely with accountants to provide an integrated advice process across wealth and accounting. We think this is so important to make sure that when you're working with your accountant, that you get other experts in the room to help assist to make sure that you're meeting not only your taxation objectives, your financial objectives, your structuring objectives, but also your wealth objectives across those different areas. So that's something we've been doing since 2003, and we've found that having an integrated advice approach really makes sure that you as a client are in the middle of any decisions, and by consulting with other experts means that no strategies are missed. We follow a unique process in relation to our advice process, which is structure, strategy, tactics, review. So everything we do follows this process. The structuring is so important. This is where your accountant is so important to sit down with you to work out what is the best structure for you to own investments in, whether it's a company, a family trust, a superannuation fund, personal names. Strategy is really around what are the tax strategies and the financial planning strategies that should be adopted for you at your current life stage. And there's plenty of those which I'll go through in a moment. But also strategy around what investments to be purchasing, what asset allocation to have given the current economic environment or the outlook for the next 12 to 18 months. Tactics, no plan is is to set and forget. You have to make sure you're doing tactical changes to any investments or any strategic advice. So having these tactical changes is very important, and also reviews. For us, having constant reviews with clients is so important because circumstances do change and they can change daily. As we know with COVID, and I know we're speaking with Craig James this week, they've kept revising their numbers, I think by the hour or by the day. And the good thing Craig had to say was they're actually more optimistic about the numbers, which is great. So I won't steal his thunder, but I think that's a real positive for the Australian economy. So I just wanted to welcome our attendees who are aligned with some of our partner accounting firms across Australia, being Caracal Accountants, KKP, Proctor Major, Morgan Wealth Partners, OHM, Bentley's, McKinsey, Ross, Harrington McNamara, Tenwork and MyFly. So I welcome all those people attending through the invitation from our aligned partner accountants. So thank you for your attendance. Just this slide here, I think is a really good slide that just shows life's journeys and where there's a different advice needs and wants from individuals depending on where they are in their life stages, ranging from teens through to early 20s to 30s. And we can see with this graph here that the red shows our life's choices, the wants we have, and the orange is actually life's needs. So you can see that at different stages, people have different wants and needs. But the key is to actually be able to have a lifestyle and an income and resources to allow us to meet not only our needs, but also our wants. And that's why we think it's really important to get great strategic advice, not only from your accountant, but also from an advisor, and them two working together. So we can see that, in the early 20s, most people are sort of at university studying. 30s, you start their career, looking at buying a house, borrowing, taking on debt, establishing a family. Those needs are different than someone perhaps who's in their 60s looking to retire, wanting to make sure that they enjoy retirement. That means their lifestyle won't change from the lifestyle they enjoyed while they're working. Which is really, really important thing to note is that covering all those life's journeys is something that we think is important to make sure that all those needs are met. The challenge that we do face now as a society is that we are living longer and working shorter hours. This graph here is really interesting. This shows that in 1939, the average person started work at 16, and they actually passed away. The average life expectancy was 63 years of age. So there was really no need for retirement planning because the average retirement, the pension age wasn't until age 65. So there was no real need to actually look at retirement planning given life expectancy was quite short. If we fast forward 40 years to 1979, you see the people entering the age of people entering the workforce actually increased to age 20. People were finishing their secondary schooling. Perhaps, this is where university studies commenced. And people were actually, retiring at 60, but the average life expectancy, which is really important to note there, was only 71 years of age. So you only had to have enough money to fund 11 years of retirement. If we fast forward to 2019, we've seen a huge reduction in the amount of years working. We've also seen a later entry into the workforce, and this is because most people commence tertiary education. And we would think 23 is most of the youngest age of most people in the workforce now. I know a lot of my clients with kids who are at university, they go back and do their masters. So they may not be entering the workforce till 25 years of age, and the average retirement age is 58. So you can see here that the number of years working actually is a lot shorter than the number of years in retirement. So therefore, there is an issue here around how do we create enough assets and wealth to fund a lifestyle that's going to last a lot longer than 58 years of age. You can see 82 years of age is life expectancy. We also know today that with a child born today, they'll most probably live to over 100 years of age, which is really interesting. So there is a challenge here around us living longer and working shorter, which has to be addressed through good planning and preparation. Just an interesting graph here, I hope everyone can read. This is in relation to a survey that Westpac and ASPA do every 3 months in relation to what level of income you would require in retirement to have a comfortable lifestyle and a modest lifestyle for a couple or a single. And they break it down across all the different expenses that a household budget will have, during the year. What's interesting to note here is for a couple to have a comfortable lifestyle in retirement, they need about $62,000 a year. So that would mostly equate to about $1.2 million in superannuation. For a modest lifestyle, it's about $40,000. Now, for a couple and about $27,000 for a single. That modest lifestyle is really, in my view, is a bare minimum lifestyle, given that's effectively what the age pension rates are for a couple and a single. And if we look at $62,000 a year, that sort of lifestyle is not an extravagant lifestyle at all. It's being able to eat out down the high street once or twice a month. It's being able to continue your private health insurance during retirement. It's maybe travelling overseas once every 4 years, perhaps upgrading your car once or twice during retirement, being able to entertain family and friends at home, grandchildren once or twice a month. So not an extravagant lifestyle at all. So we would think that most people would want to be aiming to actually have more of a lump sum than $1.2 million to allow them to enjoy the lifestyle they had before retirement. So the first strategy I want to talk about today is why it's so important to start with structures, because we know that investments, no matter what structure they're held in, will return the same return. So, for example, if you own BHP in your own name, it's going to have the same capital growth, the same dividend, whether you hold it in a company, a family trust or a superannuation fund. However, it's the after-tax returns that are so important in relation to investing. And this is where we think it's important to sit down with your accountant and work through, okay, what life stage am I at? What is the best structure for me to use at this point in time to minimise tax, to make sure that I generate the most returns, the after-tax returns from the investment? And, we talk about tax should be thought of hitting a golf ball into a headwind. If you do this, obviously you'll limit the distance the ball travels. We can't control that. However, you can control the tax outcome, which is really important. So understanding all the different tax structures and utilising those during the different life stages is so important in relation to wealth creation. And, these are the different tax structures that are available, ranging from superannuation, which we know still is and will continue to be the most tax-effective tax structure in Australia. And we know that during accumulation phase, the maximum tax rate on income is 15% and 10% on capital gains. We know that once you reach preservation age and retirement, there's no tax on any earnings within the fund, up to $1.6 million per individual, and no capital gains tax. So a really tax-effective structure. However, superannuation, as we know, has restrictions around access to it. So you don't want to be putting all your money into superannuation at an early age. Trust structures are really good. It allows the ability to distribute income out to individuals. We have personal tax rates up to 49%, so most probably not the best tax structure to be investing in. And we know the company tax rate now has been reduced to 27.5%, however, no CGT discount. But really important to determine what is the best tax structure for you at your life stage. Franking credits, all the accountants who are dialing in will no doubt understand this back to front, but one really overlooked strategy that most Australians do is they don't understand the benefits of franking credits, which is income that's being paid on dividend income, which is paid to you as an individual, whether it's in a company, superannuation fund or a family trust. We know in Australia that most blue chip companies pay dividends. We have seen COVID impact, how much is being paid as dividends at the moment. However, we would expect that to recover in a couple of years' time. We know that the company tax rate can be as high as 30%. And if the company pays tax on any dividend income, you as the individual, the structure that's held in will actually receive those dividends back as a credit. So this example here that we're going through here looks at someone who's on an example of a tax rate of 39%. They've got $100,000 and they decide to put that money into the CBA at 3.5%, which I know is very generous given the current interest rate environment we're in, but we thought we'd just use this for illustration purposes. And no doubt if we use the current term deposit rates, this illustration will look even more attractive. So effectively, after you pay tax on the 3.5% income, your only net return is actually $2.14. If you were to own a CBA share, assuming a 5% dividend yield, the franking credit of $2.10 is effectively refunded to you. You then pay tax on that $7.10 at your marginal tax rate. So the after-tax return is $4.33, which is really a lot more than the term deposit. Obviously, a share has more risks than the CBA term deposit. However, you look to manage those risks. And then if you look at the preference share with the CBA paying 4.2% fully franked, the after-tax return is $3.62. So a really powerful way to boost up your wealth, but also to allow more income in retirement if you're looking at generating income from your investments. And if we look at this example again, assuming that that these investments are held in a zero tax environment, which will be a superannuation fund, you can see that the after-tax return is $7.10 within the super fund and $3.50 for term deposit, and $5.94 for the preference share or the hybrid share. Once again, different growth characteristics and risk characteristics, but a very good indication of how franking credits can help boost people's wealth. Installment investing, this is something that's been around for a long time. It's really around having a savings plan in relation to investing into assets, and it's quite successful. So what installments mean is that effectively making investments constantly into an investment by using not only your own capital but also using borrowings to actually boost the amount of lump sum that's available at the end. So this example that I'm going to run through today, we have someone who's got $10,000 looking to start a savings plan, and they've done their budgets, done their cash flow, and they've worked out they've got $750 a month of surplus income. So we're looking to actually put that money into a diversified portfolio of cash, fixed interest Australian and international shares, and buying into that asset every month. Using instalment investment, you can then borrow an additional $750 on top of your own money. So effectively, $1,500 a month is going into this investment. If we assume an 8% growth rate for the investment, which we'd expect from a growth portfolio, it's not going to be consistent 8% every year, as we know. You might get 16, 20%, 25% one year. However, you could get 2% or a negative return. But if you look at an average return of 8%, you can see that the portfolio would be worth $416,350 net of the loan after 15 years. If you don't use the instalment gearing strategy, the result after the loan, the actual amount available is only $291,848. So you can see there's a significant benefit of actually utilising some gearing with instalment investing to actually generate wealth. The other good thing about using this type of strategy is your dollar cost averaging into the market. So you're not putting all the money in on day one, perhaps when the market will be at all-time high. You're actually averaging your average cost in the market, which is a risk mitigation tool. And this slide here actually just goes through and illustrates that. So the return on equity is about 102% using this instalment gearing strategy. This next strategy is in relation to borrowing within a superannuation fund to acquire an asset. And this legislation has been around since 2007, which only seems yesterday that it was Costello, who was the Treasurer at the time, who allowed for this to occur. And this was originally called an instalment borrowing arrangement, and now it's commonly known as a limited recourse borrowing arrangement. And this effectively came about because people who had self-managed super funds had bought Telstra instalments, everyone can remember those, T1, T2, T3 in their self-managed super funds. And effectively that was the right for the holder to actually acquire the full Telstra share by making an additional payment. Now, superannuation funds aren't meant to borrow, and so a query went up to Treasury and the ATO saying, are all these self-managed super funds in breach? And the thought was that they'll come back and say, yes, they are, and they'll allow some time for the breach to be rectified. However, the ATO came back and said, well, we'll allow instalment warrants to actually purchase assets in the super fund that you can use for cash. So that opened up the ability for property and shares to be purchased using these instalment warrants. So this slide here just goes through and indicates how this works. It's a bit going on here, but effectively how this works is you have a superannuation fund, and effectively the superannuation fund can use borrowings to purchase an asset. In this case, we've used a property. The property cannot sit in the superannuation fund because there's some rules around having a superannuation fund asset encumbered. And so there's an agreement between the superannuation fund and the security trust, which effectively says the superannuation fund is the beneficial owner of the asset. It has the right to acquire the asset when a condition is met, and that condition is clear title. So you can see in this example here, the superannuation has purchased property worth $500,000. $400,000 is lent to the superannuation fund, and the property then pays rent into the superannuation fund, and that rent and contributions from the members are then used to pay down the loan. So what's the benefit of this type of strategy? Well, it allows individuals to get more assets in this concessionally taxed superannuation environment immediately. So effectively by borrowing $400,000 in this example, there's actually an additional $400,000 in the superannuation in that concessional tax environment, which is fantastic. If an asset was held until retirement, the rental income is tax-free, which is fantastic. This is a great strategy for self-employed people who want to purchase the business premises and be the tenant and the landlord. It's a great way to actually, own the business premises at your operating fund. And so instead of paying, your lease payments to an external landlord, you're paying them to yourself. Your super fund is a landlord. which is a great way to actually get money out of a company at a lower tax rate, which effectively can be 0% or 15%. The asset is sold after retirement, there's no capital gains tax, or if it's sold during accumulation, only 10%. Also a way to reduce contributions tax and pay off the property quite quickly. So this example we've used today, if we look at these sort of basic numbers here, the interest rate is 7.5%, which is most probably a little bit higher than what you get today. The value of the property was $500,000, receiving a 4% rental yield, loan balance $400,000, $25,000 is being contributed as concessional contributions. We can see there's income coming in of about, between the rental income and the concessional contribution of $45,000. There's an interest deduction of $30,000. So the tax on the income after deductions is, in this example, is $2,250. So this allows $12,750 of capital to be repaid every year. So it's a really effective way to reduce the loan very quickly. And if you look at the effective tax rates, it's 5.5%, which is pretty effective way to accumulate wealth and reduce tax. Superannuation splitting, this is a strategy that most people overlook. And what we think now is, given there's now restrictions on how much money an individual can have in superannuation that is tax-free, which is $1.6 million per individual, it's really important to make sure that spouses have an even level of superannuation within their superannuation funds, and making sure that one spouse doesn't have a high amount, which can be subject to more tax, but also can restrict ability to pay pensions early. So effectively, spouses are allowed to spend 85% of their concessional contributions each year to their spouse. However, the spouse must meet the requirements to accept the split. So there's many strategies around this. If we have couples who have an age difference, it allows for splitting to a younger spouse under the age pension age to shelter the asset against the Centrelink assets test, which I'll talk about as another strategy a bit further on in the presentation. It allows for a younger spouse to split to an older spouse who already have access to tax-free benefits. It allows you to access 2 tax-free thresholds from preservation age, which allows for individuals to take money out and put it back into the fund, and that allows the best use of marginal tax rates. And the important thing here is accessing to 1.6 million tax-free pension limits. Legislation was recently changed to say that any monies people have in superannuation over $1.6 million is subject to tax. So you don't want to have a spouse a couple where one spouse has got $2 million or $3 million and the other spouse is zero. You want to make sure that you look to even up those superannuation accounts to make sure that you're minimising tax, to allow you to accumulate wealth, to allow you to meet your retirement objectives. So in this example, we've got Jim, age 56, and his wife is 60. His income's $85,000 with superannuation of 9.5%. Mary is retired. So Jim's contributions to his SGC is $8,075 per annum. He decides to salary sacrifice to take up to his concessional cap of $25,000. He can then effectively split $21,250 to his spouse, which is the after-tax contributions that he's made each year. What that allows, and she can access that money because she is actually retired. So by increasing his salary sacrifice, his contributions and salary sacrificing, he's saving $4,000 a year in tax. Mary can then keep that money in the superannuation fund and invest that in a pension, which will mean there's going to be no tax on the earnings. And also, because Mary is now reached preservation age, she can access those funds if they want to draw down on those funds and just lock in that tax savings. So a really effective strategy there. Transition to retirement strategy. This has been around for a number of years, and it's a tax-effective way of increasing your super balance while maintaining your take-home income. And this was introduced to allow people to transition to retirement. In the past, you can only access your superannuation if you were retired from work, and the government realised this was causing an issue where people didn't want to retire on day one and not work at all. They wanted to continue working a couple of days a week, but the income they were earning a couple of days a week wasn't sufficient to meet their lifestyle needs. So they effectively said to the government, well, we need to have an area where people can transition to retirement, work a few days a week, access their superannuation in form of a pension, but also be able to contribute. But this has opened up an opportunity for people to continue to work full-time, salary sacrificing their superannuation and get significant tax savings, but then also access their superannuation. So effectively, with the transition to retirement income strategy, we save up to 34% tax, marginal tax rates. It also allows for the investments to be made in a tax-free environment. So effectively, this strategy, if anyone is over the age of 60 and working, this strategy will be effective for them. And if they want to continue working 65 or 70, the tax savings are quite significant and compound over a number of years. So in this example we're using, we've got Jim, who is 60 years of age. He plans to retire at 70 years of age. He has a salary of $100,000 plus superannuation, has little surplus income. So if we're looking at this here, we've got his cash flow. Sorry, everyone, so his cash flow is unaffected by him salary sacrificing. By putting the maximum amount in, he's reducing his taxable income from 39% to 15%. Someone's drawing on the screen here. Sorry, I'll just try and correct this. There we go. There you go. Technology, the joys of technology. So this example here, by allowing him to salary sacrifice still actually superannuation, he'll actually add about $79,000 to his superannuation balance over 10 years using this Treasures to Retirement strategy. This is a new strategy, which is a concessional contributions catch-up, and this was something that was introduced recently, which allows individuals who will not maximise their concessional contribution to superannuation, being up to $25,000 a year, to actually use concessional contributions to be rolled forward and used in a year where perhaps their income is higher or there's a capital gain tax issue. And a large deduction can be claimed and it can be used to offset capital gains. So in this example here, we're looking at this individual person here, Jill, she sells an investment property with a $200,000 capital gain. If all that $200,000 had to be declared in her income, she'd be looking at paying tax of about $67,000 in tax, which is not a great outcome. In this example, Jill's not contributed to superannuation for 3 years. So she utilises the concessional catch-up and makes a $75,000 concessional contribution. So what that means is that it allows Jill to get a tax deduction of $75,000 in her personal name to reduce her personal tax. So that reduces their income tax payable in their personal name from $67,000 to $36,000, which is a significant saving. There will be contribution tax of 15% payable on the contribution. However, even with that contribution tax of $11,250, we are seeing a total tax saving of $20,000. So a really effective strategy that can be used and utilised, and one that's often overlooked by individuals if they have a very good tax year in relation to income, or they have a one-off windfall gain through the sale of an investment that leads to a capital gain. One thing that's really important to talk about is the importance of making sure that any investment portfolio is structured in a way that's going to allow for enough income to be generated, but also to allow for there to be a bit of a buffer in there if there's volatility in investment markets. And what we talk about at Partners and with our aligned joint ventures is that making sure that the investments that people are investing in are put into 4 separate buckets to allow for any volatility in the markets not to impact the investments, and also there's no need at any point in time to sell down an investment that has had a capital loss. For example, if the share market has been volatile, which we've seen since May. So what we effectively look to do is we look to have 4 different buckets. And in this example here, we have $700,000 in a superannuation fund. We look to allocate $200,000 into the growth approach, which is shares, international shares. We have an active approach, which is more around your fully franked Australian shares, managed funds. We have a high yield, which is fixed interest, which is hybrid securities, high fixed interest funds, international fixed interest, and then you have a cash bucket. Effectively, if we look at the cash bucket here, assuming it returns 2%, you have $2,000 in income. The high yield, being conservative here, we're looking at a 5% yield, which provides $10,000 in income. The active approach with the fully franked Australian shares, it's property assets, you're looking at $14,000. And then with the growth approach, which is your international shares, you're looking at about $10,000 a year distribution. So in this example here, a couple, they'll receive income of about $49,000, which includes some Centrelink benefits they can receive. The important thing to note by structuring the assets this way is that we know that at any point, if there was a sell-off in the equity markets, there was enough cash, being $100,000, and enough assets in the high yield, low volatility to actually fund the income requirements of these retirees for at least 5 to 7 years. So there'll be no need to sell assets that have gone down in value. It will allow time for the portfolio to recover. We know that portfolios recover over time with the volatility, so it means that no assets are sold, obviously locking in a capital loss and obviously reducing future capital within the fund and impacting future ability to pay out higher income. So a really effective strategy. And in this case here, example here, similar portfolio with clients, for example, $2 million in their superannuation fund, knowing they can receive $72,000 a year just off the income of the portfolio. Also understanding that in the event there is some volatility, markets going down, there is about $200,000, $800,000 in growth assets, $800,000 in defensive assets, which can be drawn on with no need to sell down any of the active approach or the growth approach within that portfolio. Something that's really important to understand, and that's obviously important for diversification within the portfolio, and something that we take very seriously here at Partners Wealth Group. This strategy here, number 9, is something that most people aren't aware of, and this goes back to 2007, actually, when Peter Costello, the headlines after his budget were in relation to tax-free superannuation for all Australians, and spoke about the fact that there'll be no tax on superannuation. We know that has changed a little bit, but one thing he didn't mention, which was in the fine print, was the fact that if part of your superannuation fund is taxable and deemed taxable, if that money is paid out to non-financial dependents, such as adult children, grandchildren, etc., there is tax of 17% on that money. Now, the taxable component of a superannuation fund is money that's been put into the superannuation fund where a tax deduction has been claimed, and that may be the employer contributing your SGC or a salary sacrifice, or it may be personal concessional contributions where you've had a tax deduction. So there is a way to solve this issue, and that's by tax exempting the fund, and we call this a withdrawal recontribution strategy, which allows after the age of 60, because you can take out superannuation money is tax-free, allows you to take money out and recontribute it back into the fund to effectively reduce that tax implication. So this example here, we've got Jim, who's 63 years of age, he's retired, he's a widower, he has $700,000 in the superannuation fund, and his fund is 100% taxable. So what that means is all the money that's in Jim's fund is actually money that has been contributed and someone's claimed a tax deduction on. There's 2 adult children who would like to be the beneficiaries of his superannuation fund. Under this current arrangement, on that $700,000 will be taxed at $119,000. So what we can look to do is we can look to do a withdrawal recontribution where we'll take $100,000 out, put it back in. In the next financial year, we can roll forward 3 years contributions, take $300,000 out, and effectively tax exempt that to make the fund actually have zero tax now. So that $119,000 tax issue has now disappeared. Something that not many Australians are aware of, but something that can be easily fixed through a withdrawal recontribution strategy. A lot of the strategies I've spoken about around wealth creation, one important aspect, which obviously goes hand in hand with any holistic approaches in relation to estate planning. We've seen many instances where estate planning hasn't been implemented. It does cause lots of issues and grief for the beneficiaries or the loved ones of the person passing away. We see a lot of issues where people do have simple wills, and I think speaking to the lawyers at our business, the news agency wills most of them should be outlawed. They are cheap to buy and fill out, however, they must be create a lot of litigation. Unfortunately, given they're quite simple and don't really cover the wishes of the party, and they're often open to dispute and conjecture. There's many tools in relation to estate planning, not only just the will. There's powers of attorneys, which can help people who are with investments with becoming incapacitated. Binding death benefit nominations. Now, this is an estate planning tool. Not many Australians are aware of this. However, superannuation is not an estate asset, so specific instructions have to be placed on how you want the superannuation to be paid out. That can be paid out to dependents, can be paid out to non-dependents, or a direction can be made to be paid to your estate to be distributed in accordance with your will. Now, family trusts are another important structure which don't form part of client's estate. And testamentary trusts are another structure that we recommend to our clients who want to have significant assets, who perhaps don't want the beneficiaries to get full control of, but still get the benefit of the income and capital growth from that asset. Some really important discussions to be had with your accountant, lawyer, and financial advisor around what do I want to have in my money, who do I want to have control of when I pass away. And the bonus strategy here is in relation to maximising Centrelink benefits in relation to a couple. This example here I run through today will show that the ability for a couple to actually access age pension when there's an age difference between the couples to allow for less drawing down on superannuation in the early part of retirement. With Centrelink, there's two tests that are governed against the ability to receive an age pension, and that's the assets test and the income test. And depending on whether you're a homeowner or a non-homeowner, the marital status will determine the level of assets you can have, but also the level of income that you can have. And the way that Centrelink run this test is the test that gives you the least amount of income will be the test they will use in determining the age pension amount. So in this example here, if you look at a couple, the minimum amount of assets they can have to get a full pension, excluding the family home. The family home is not included, it's $401,500. And if their assets, excluding the family home, go above $876,500, they will lose their pension. And with the income test, they can have between $8,000 and $8,000 in income. One little strategy that most people don't know is that assets held in a superannuation accumulation account do not count as an asset when Centrelink look at the assets of the household. And this is a great strategy to use when there is an age difference between spouses. So in this example here, we've got Jim, age 66, married to Barbie, who's 57. So there's age gap there. Jim has $876,500 in his superannuation fund. As Jim is age pension age, the full balance of his superannuation counts towards the Centrelink assets test. So effectively, given the size of his superannuation balance, Jim is ineligible for an age pension because his $470,000 is above the threshold of $401,500. So his reduction in age pension is about $18,500 a year because he's knocked out. Utilising this strategy, we know that any person who's in accumulation under age pension age, the assets do not count. We can look at a strategy where we'll look to take money out of Jim's superannuation fund and allocate that into Barbie's superannuation fund. So in this strategy here, we've said we'll take out $100,000 in June 2020 and then put that into Barbie's fund. We contributed that. In July, we'll take out $300,000 and contribute that into Barbie's fund. No tax payable on the withdrawal from the superannuation fund, and no tax payable when it's contributed back into the Barbie superannuation fund. What we've effectively done there is we've actually shielded that $400,000 from Centrelink, and effectively what that means is it means that in this example, there's a pension payable of $18,500 is received for 9 years, and that 9 years is until Barbie reaches age 65, which is effectively her age pension age. So that the benefit of this strategy is about $166,000 over that 9-year period. So something that's often overlooked and a really important strategy. I remember doing this strategy with a client of mine about 12 years ago, and very similar example to this. And I'll never forget the day that his wife turned age pension age. He rang me up and was pretty upset that he lost his pension and was upset I couldn't do anything to get his age pension back. So I had to explain to John at the time that I think we've got about $150,000 in age pension, which most probably would have missed out on if we didn't know the strategy, but you can't keep everyone happy all the time. So they're effectively the strategies I wanted to cover off at a high level. I hope everyone got some benefit from that. I'll now look to pass over to Craig James, who'll be providing our COVID economic update. Really excited to have the calibre of Craig presenting to the exclusive benefit of us today. I think most of you would recognise Craig as the on the morning show Sunrise on Channel 7. He's well-renowned economist, high profile. So, Craig, I might just throw over to you now. I'm looking forward to hearing your insights in relation to the Australian economy, how we can come out of this COVID. Thank you.
Well, I've unmuted myself now. Hopefully you can hear me. So Patrick, if you can give me the thumbs up, so that you can hear
me.
Good.
Yes.
That's the first thing that we've managed to be able to get through. So once Patrick's screen's off,
I'll just stop sharing in a moment.
And then I'll put my screen up there. That's the second piece of technology. So as long as we overcome those sorts of hurdles, we're doing very well. Now, can you see my screen, Patrick?
Yes.
Thank you. Now, the other thing, I'll just click in here. Can you see the disclaimer slide, everyone? Right.
Yes.
Right. We've managed to overcome all the hurdles. You can hear me and you can also see the slides. And yes, the last thing you want to actually see is my picture here, but I'll leave my picture up here just in case anyone's interested. That this is not a tape. So there's a real live person here, communicating to you today. So I'm calling you and speaking to you from Commonwealth Bank Place in Sydney, down near Darling Harbour. I know a number of you are speaking from or joining this webinar from right the way across Australia, over there in Perth and western areas, sort of the country, regional Victoria, regional West Australia and New South Wales. Wherever you're joining from, it's great to have you here today. I did look at some of the the different tiles that were up beforehand. Most of you, I think, in your kitchen or your dining room or your home office, and hopefully you're all comfortable. Sit back and relax. This is going to be a very painless process. I'll probably speak for around about half an hour or thereabouts, and then we'll have some time for questions later on. I'm not sure whether you saw all the news today. There's a bit of news out today that there's only 14 coronavirus cases in Victoria today. I think if you go back to late July, early August, we were seeing 600 or 700 cases, today. Now it's down to 14. So that's great news for Victoria, and great news for the economy more generally. 4 cases in New South Wales, and I think there's negligible cases here in West Australia. The last time I saw you had 3 cases a day or so ago, and the only cases that seem to come through is off some of the ships off Port Hedland. But that's good news in terms of the virus. Patrick said beforehand, if you had said to him, 12 months ago that we'd be doing this sort of presentation, he would have, laughed at you. Well, 12 months ago, I didn't think about putting coronavirus on my introductory slide for my presentation. So certainly a lot of things have changed in a very short space of time. The other news that came out today, the final budget outcome for the last financial year, the year ended June, was a budget deficit of $85.3 billion, 4.3% of GDP. So it's a big budget deficit. Is it going to get worse from here? Well, it is. Over the coming financial year, we're likely to see a budget deficit up in the order of 185, perhaps more than that, perhaps 200 or 230 billion dollars. Here in Australia, that basically equates to over 10% of GDP. So clearly, the money had to be spent. So the job keeper, the job seeker, the cash handouts for the more vulnerable in the community, the assistance for the business sector. Because clearly, so we needed to be supported to be able to get through this process. We've just had the end of the June financial year, and that was a downturn in our economy of 0.2%. But this year that we're currently in, the financial year, our expectation is we're going to see a downturn in the economy of around about 1.6%. So put it in context, the last time that we saw a decline of that order of magnitude, you have to go back to 82, 83. And before that, you have to go after the end of the Second World War. So we are in extraordinary times, but the good news is we're working our way out of the situation. Now, there's that disclaimer slide. So to anyone who's from a compliance background and whatnot, this is your slide. What it says is basically, I haven't travelled all around Australia. I don't know your own personal circumstances, so it's very much of a general nature. The good news about having this slide is if you want to get a copy of the presentation from the Partners Wealth Group, see any of your contacts. If you want to get a copy of this presentation, there's not a problem in terms of handing it out to you because it's got this slide attached. So certainly make use of it. I thought, it'd be a useful way to start off, this presentation by highlighting the fact that what we're in is very much a global event. The old adage, or the adage that we keep on hearing about, that we're all in this together, well, that is very much the case. It's in Brazil, so it's in the Bahamas, so it's in London, it's in Sydney. We're seeing coronavirus right the way across the globe. So we are very much in this all together. What we were seeing is a common feature that's occurred across the globe where economy has gone into lockdown. If we hadn't have gone into lockdown, the virus would have continued to spread throughout the community, and clearly the health resources wouldn't have been available to be able to keep everyone alive to the extent that we are now. we've seen a significant response by federal governments, by state governments, by central banks across the globe, slashing interest rates and increasing the amount of spending. Of course, the big issue now is what shape is the downturn and recovery going to take. Very much it's likely to be a recession that we're seeing right the way across the globe. So certainly we're in recession here in Australia, but something like 90% of the countries around the world are going to be experiencing recessions, over this year. The more important question is what sort of recovery are we likely to get? Is it going to be a little bit of a U shape? Is it going to be sort of L shape? Is it going to be W shape? Our view is that it may not be the bounce back V shape, but certainly we are in recovery phase at the moment, and we've been helped by sort of the very significant measures that have been put in place by federal, state, territory governments, as well as the Reserve Bank. The big thing, I suppose, in terms of how do we get out of this situation, it's not in terms of economics, it's not in terms of central banks. It's a case of keeping the virus suppressed, treating the virus, keeping sort of the number of sort of deaths down sort of from this virus, and the vaccine, the all-important vaccine that's sort of being developed by a number of institutions across the globe. As I said right from the start, the same sort of approach has occurred right the way across the globe. We've gone into lockdowns, and there's different sorts of lockdowns that have been sort of put in place by countries around the world. Different approaches. Some have been more lax, such as the Swedish or the Nordic sort of situation. Some have been a lot tighter in terms of locking down the economy, like New Zealand, certainly locking down everything that wasn't bolted to the floor. And what every country has tried to get a balance between the health issues and the economic issues. We've seen certainly travel bans, and they remain in place. And we saw the oil price fall to next to nothing. Clearly, so people are travelling, so that's less demand for oil. And what we've seen is response by the oil producers. They've reduced the amount of supply in the market. So we've got a bit more balance in the oil market. So oil prices, sort of stabilise. But you can see from this chart, we've seen countries right the way across the globe spending money significantly. You look at that chart right on the right-hand side, the advanced economies, the AEs, you can see that something like 9-10% of GDP has been allocated to spending on the economy. Now, the blue line is basically things like loans, equities, and guarantees. The red spending is spending and foregone revenue, so tax cuts, the amount of spending which is by government. So we're seeing sort of upwards in the order of sort of 10% of GDP, sort of for both those measures across the advanced economy. So it has been very, very significant in terms of the amount of spending that's occurring. Okay, what about Australia? How are we compared sort of in terms of this situation? Well, you can see how other economies around the world have fared in the June quarter, the all-important June quarter, the April, May, June period of time, where really economies right the way across the world were in lockdown. We had a 7% decline in our economy in that June quarter. That was actually one of the best results amongst the major economies across the globe. So when the Federal Treasurer and when the Reserve Bank Governor talk about the good news in Australia, the fact that we've managed to get through this situation a whole lot better than the rest of the world, they're not gilding the lily. Certainly, so the figures are backed up. And this chart actually on the left-hand side was taken from the Bureau of Statistics after the national accounts were put down. You might see that so the third from the right, the bar there, that's the United States, a downturn of 9.5% through the economy, something like a 32 or 33% annualised rate. And the UK economy fell by over 20% in the June quarter, a dramatic downturn in the UK economy. Fortunately, it's working its way back, but they've now experiencing second wave, so it might be a little bit more protracted, the recovery there. You can see our forecast for the global economy is a very significant downturn. That small bar in the middle of the screen basically refers to the global financial crisis. You can just see how we're experiencing this time compared with the global financial crisis. This is the biggest downturn that we've seen since the war, the Second World War. And before that, you have to go back to the Great Depression of the late 20s, early 30s to be able to see it's something like this. So we are clearly living in extraordinary times. The good news is we are working our way out of this. There's been no playbook that was left for us 100 years ago when we had the Spanish flu. We're trying to work out the best way of managing up the health issues with the economic issues to be able to make sure that we all get out of this, okay. Certainly get out of it, with our lives, get out of it, with our businesses, our jobs, and our wealth levels, intact. There is good news, particularly when I do presentations like this. Western Australian viewers like to know what's happening in terms of China, because it's all important in terms of the iron ore price and all important in terms of the Western Australian economy. The good news, you can see how the Chinese economy has bounced back quite smartly. In fact, there's a private sector measure of manufacturing, the Cakeson Purchasing Managers Index, and that's at the highest levels in 9 years. So we have had a nice little bounce back in terms of the Chinese economy. Clearly, they're spending money, they're putting money into infrastructure. That creates demand for steel, therefore creates demand for iron ore, and you can see how our iron ore prices are well and truly elevated. A bit of a retreat over the last couple of weeks, but certainly, iron ore prices and iron ore demand, very, very significant. But let's talk about Australia, and let's talk about, how we've managed to get through this situation. The response has been quite significant. When you think about federal governments, the state governments, the territory governments, the central bank, we really acted quickly over March. We did one measure, the first stimulus package or support package on March the 12th, and finished that up. Then we continued with that a week later, then a couple of days after that, so then a week or so after that. And indeed, we've done, very similar to the rest of the world. We locked down our economy. We provided the money to be able to support the vulnerable people who weren't able to access their workplaces during this period of time. Clearly, if you're in hospitality, cafes and restaurants, they've closed down. You don't have a job to go to. If you're like me, though, as an economist, clearly you can continue to do work right the way through the period, and that's certainly a lot of white-collar enterprises like ourselves have managed to go through the period without too much of a change in our ordinary behaviour. We might work from home instead of working from the office, but we're still putting out reports, still doing the TV and radio crosses in this sort of environment. The aim has been to keep people employed and keep businesses in business. And basically, it's a do all that it takes strategy that's been adopted by state and territory governments and also by the Reserve Bank. The government likes to say that the measures have been very much targeted and temporary to be able to support people through this situation. The hard part, though, is when do we reduce the amount of stimulus going in the economy, and how do we do that? Do we taper it? Do we do it quickly? This is something that not just we're having to contend with, but the people are having to contend with right the way across the globe. It hasn't just been fiscal measures in terms of spending, tax cuts. It's also been interest rates reduced to almost nothing, 0.25%, here in Australia. Direct measures, indirect measures like the loan guarantees and holidays. We're seeing from the Reserve Bank, the term funding facility that enables banks to be able to lend out at very, very cheap interest rates. And something that you may not have heard today, the Commonwealth Bank actually reduced its standard variable housing rate this morning by 10 basis points. So yes, clearly nothing to write home about, 10 basis points, but it's just a further reduction in interest rates. And indeed, so if you're paying off a mortgage, so speak to your Commonwealth Bank, representative and see, what it means for you. One of the other things that's been happening is access to superannuation. This is something that we haven't really seen, beforehand, but enables people, particularly young people in their 20s and 30s, and they say it's a long time to retirement. I can rebuild my savings over time, but I want to maintain my lifestyle. I want to be able to get through this period of time, and we've seen that access to superannuation. You can see there's a couple of nice little charts there in terms of the economy over time. You can see, so the Australian economy, economic or change in GDP, economic growth most of the time, back to Federation in 1901, and the federal budget, so going back to 1901 as well. As I said from the beginning, we are looking for a contraction in the Australian economy around about 1.6% in the current financial year, which would be on par with the 82-83 recession. So it may not be as bad as things like the Depression or the end of the Second World War, but we've still got a little bit further to go to be able to get through this one. As Patrick said beforehand, we keep on changing our forecasts. Things keep on changing on us, and we have to respond to the environment. We're spending a lot of money. What we've calculated is that over $300 billion has been outlaid by federal government, some measures. And I was heartened to see that the Federal Treasurer today did refer to the fact that over $300 was spent. So it looks as though I've got the figures right in terms of this. Once you count in the state and territory governments, what we've got is something like nearly $340 billion or 17% of GDP has been thrown in this situation. As I said beforehand, it's very much targeted measures, things support for the childcare centres, childcare industries, for the aviation sector, the JobKeeper, the job seeker packages, which are certainly really dominate the amount of spending. But we haven't left a stone unturned in terms of providing the support that's needed in terms of our economy. As I said, the hard part comes next. And clearly the media constantly focuses on this, what's going to happen in 3 months' time, what's going to happen in 6 months' time, how are the measures going to be tapered off. And I think the government still, remember I said, there's no playbook that's been left for us. We have to work out this situation ourselves. We just have to respond to everything on a day-to-day basis. Some of the changes that we're seeing in the economy over this period of time have been quite dramatic. First recession in 29 years, wage and price growth. We haven't seen anything this low in terms of growth rates for the order of 22 years. In fact, the consumer price index was the biggest fall in 89 years when we had those June quarter inflation figures. It may surprise you to know that retail spending isn't going nowhere, isn't flatlining. It's actually doing quite well. And I'll speak about that as we go through the presentation. The budget deficit, as I mentioned, this financial year that we're in, is likely to see a deficit around about 10% of GDP. We will know that in greater detail on October 6th, so that's when the federal budget will be handed down. And I think the good news for a lot of people around the place is the fact that home prices have been very much supported. There was a lot of concern about this, that if people lost their jobs, we didn't have the overseas migrants coming through, that reduction in demand and greater supply of people wanting to put their homes on the market could see prices really fall. But we were holding up okay in terms of home prices. Demand and supply have become some more into balance. And you would have seen from Commonwealth Bank as well as Westpac that the banks have become a little bit more positive in terms of where home prices are going to go from here. Here's some of the trends that we're seeing in terms of the job market. If you're watching this from Western Australia, you haven't had a lot of good news economically for quite some time. Well, the good news is that you're actually riding out this crisis a whole lot better than ourselves on the East Coast. New South Wales, we've seen a bounce back in terms of employee jobs, but not to the same extent in Western Australia. And Victoria, certainly we had that second lockdown period. So things were looking okay in Victoria, went back into lockdown. Now we have to work back through that process again. We are starting to see more businesses reopen around the country, and hopefully that will be the case in Victoria over the next couple of weeks as well. That means that people come out of hibernation from JobKeeper. They start going back into their businesses, their cafes, the restaurants, the hotels, and the like. Hopefully then we start to see a bit more stabilisation in the job market. But in terms of the job market, it's so far so good. It may surprise you that the people aged 20 years and under, they're actually doing pretty well in this current situation. This is an index of employee wages over time. I can tell you that my daughter and also son. Son was on job keeper. The daughter was on job seeker. The son was getting sort of more on job keeper than he was getting paid for sort of his part-time job working at a swim school. So he's actually pretty happy about the overall situation, but he's got a bit of a comeuppance coming through. He's going to see a reduction in his benefits over time. But certainly the younger have been supported by JobKeeper and JobSeeker, less in terms of the other age groups, particularly those in their 60s and 70s. They've seen a reduction in employment and not seeing wages increase as well. That's something that's not generally known about this downturn that we're going through at the moment. Let's go through the winners, losers, and those that are challenged. Well, it may surprise you to know that there are indeed winners from this situation. Now, you probably, as a number of you think back to February and March, and we had the supermarkets going gangbusters because everyone was getting short on toilet paper and paper towels and the like, and stocking sort of up at home. What we've seen though is retailers. It's not just the supermarkets now. It's organisations like Harvey Norman. You may have seen Harvey Norman's latest sales figures this week. He's had the business has had a 30% increase in sales in just the last 3 months. Now, Jerry Harvey likes to be able to talk in layman's terms. He said it's going crazy out there. This is a once-in-a-lifetime boom. And indeed, if people are at home, they've got their home offices, they're trying to make themselves more comfortable over time. Clearly, they've been getting on the computer, buying goods from places like JB Hi-Fi by Nick Scarley, by Adair's, and also by Harvey Norman. And we've seen those sorts of businesses really doing well in this sort of environment. The mining sector has continued to do well because there's significant demand for our gold, our base metals, and our iron ore. Certainly we can't travel overseas, but so as the economies start to open up, we are seeing a lot more intrastate tourism, and over the next couple of months, hopefully it'll be interstate tourism that'll be cranking up, as well. One of the things that may surprise you is that the price of your used car, if you've got a second-hand car at home, that's actually been going up in value rather than down in value. People have been a little bit more afraid about getting on public transport in the current environment. So there's been greater demand for second-hand cars, and one of the key analysts in terms of this sector, Platinum Insights, you may know of Pickles Auctions. They basically run the database for Pickles Auctions, so they've got access to a big database of car prices. And indeed, through August, we had a 25% annual increase in terms of used car prices. We haven't seen anything like that since the records go back into the late 1990s. So it's been amazing, sort of situation. We've also seen some changes in behaviour. Everyone's in lockdown period, in their own suburban home. So we've seen suburban businesses doing very, very well, but the central business districts haven't been doing so well because people haven't been going into the offices. Of course, takeaway and delivery services doing currently very well in this sort of environment. However, my suspicion is that some of the Uber Eats drivers and the like, Menu Log, they're quite happy being on JobKeeper because I'm finding it hard to get my takeaway pizzas delivered at the moment. There's just not the drivers around the place, which is quite remarkable. What are the areas that have been challenged? Universities and schools. My son goes to university. He doesn't need to go in once to the university over this session. Everything is online. So you can see the universities have adapted, the schools have adapted. It's been hard for things like the hairdressers, the beauty salons and gyms, but they've managed to cope with the situation as well. And certainly there is implications for aged care. Hopefully what we've seen in terms of this period of time is that we need to see more dollars, more support going into the aged care sector to make sure that people much more comfortable than what some of the aged care providers are actually providing at the current period of time. And then we've got the losers. Clearly, if you're not being able to travel overseas, clearly that affects the airlines. It affects things like Flight Centre, it affects things like Webjet. if we're not travelling around the place and doing these sorts of presentations in a nice hotel somewhere, clearly the hotels are missing out. I mentioned CBD businesses, cafes and restaurants doing it hard because people aren't working from the office. They're quite happy to work from home at the moment. And things like my taxi driver is constantly complaining about the lack of work which is available at the moment. And there has been some different sorts of effects in terms of whether you're old and young. You can see from the overseas arrivals just how dramatic the downturn has been. Now, if we're not travelling overseas, that means we're not spending 20, 30, 50,000 on that European vacation or the US vacation. So what are we doing instead? We've got those dollars here in Australia, haven't we? That's why we're going out to Harvey Norman. That's why we're going out to JB Hi-Fi and utilising our funds so that way. There will be lasting effects from this COVID period of time. Clearly, we're going to have different ways of doing things. I've had a doctor's appointment recently. It was done over the phone. We're getting more and more things delivered, to our home place. Distance learning, the way that we hold functions and meetings. This has gone very, very well today, hasn't it? We've been able to show our presentation. You've been able to hear from me. The sound's been, good. Technology can work pretty well. I think WebWorks works pretty well compared with a lot of the other systems out there. But certainly our way of life is changing. And we've got to think about the so what question. What does that mean for certain businesses? What does that mean for the CBD businesses? What does it mean for the local cafe, in the suburban areas? What does it mean for the wineries? I'm going to the Hunter Valley, in the next couple of days. Clearly, so you can't just rock in for a wine tasting. You've got to book it in nowadays and make sure that you're socially distant. So our way of life has changed dramatically, and indeed it's going to continue to do so. What about the housing market? I said that the housing market has held up very, very well. Certainly some of the ways that it's held up is the fact that interest rates have been kept very, very low. There's been holidays in terms of mortgage holidays, so people haven't had to make the usual sorts of repayments. And the other thing is, a lot of people were ahead in their repayments, well and truly ahead in their repayments before we got into this period of time as well. That supported the housing market as well. So you can see what's happened in terms of home prices. Sydney, we're seeing a retreat, over time. In May, we had something like a 4 or 5% gain from the start of the year. You can see that those gains have been frittered away. But if we end the year where home prices are relatively unchanged for a full 12-month period, I think most people would heave a sigh of relief and say, we've done pretty well in this sort of period of time. The ongoing effects, is something you'd be able to focus on. Because if we don't have the overseas migrants coming through, it is going to affect the building industry. It is going to mean reduced amount of homes being built, perhaps renovations, the like as well. So there is some ongoing effects that we probably haven't come up to yet, and certainly will be fleshing out through 2021. The building materials sector, the construction sector, and the like. What we will have in replace is a lot of infrastructure, things like roads and bridges and dams and those sorts of things, trams that are being built around the place. That's going to continue to rack up, whereas home building is going to be a little bit softer over time. Well, there's the home prices yet again. You can see that home prices in places like Sydney are still well and truly ahead of where they were 12 months ago. You may shake the heads and say that these figures are made up. Well, CoreLogic goes to pretty fine detail to be able to pick up every transaction in the housing market. I can tell you these are the most kosher figures that you're going to get in terms of the housing market, showing that clearly home prices are holding up okay. Now, it may even not be so good in terms of Perth at the moment and the Western Australian areas, but things are starting to balance up quite nicely, and where our expectation is when we get into 2021, we're going to see more growth in terms of Perth home prices, supported by population growth, which is growing at something like the fastest rate in the order of 6.5 or 7 years. Let's talk about the share market, because I know a lot of you want to be able to focus on that. You can see what happened in the early part of the crisis period when we went into lockdown. The share market basically plummeted. Now, This is very similar. If you look at the Malaysian share market, if you look at the UK share market, US share market, you'll see the same sort of trend over time. Countries went into lockdown. What we saw is so the share market tanking. Our currency sort of tanked as well. There's fear of the unknown. That's what FOTU stands for. People didn't know sort of how it was going to work out. But things like low interest rates, the stimulus that's been provided, degree of success certainly here in Australia by COVID has supported the overall situation, and that's seen the share market recover. It took 22 days from Australia's share market to go from its highs to lows, and a fall of something like 37%. Over the next 20 days, what did we gain? We gained by 21%. And certainly we're seeing here in CommSec more and more people coming into the share market. Certainly when the share market was at lows, people said, no, this is crazy. We are going to work our way out of this situation. And they've certainly proved right, sort of so far. We're currently down 5%, some of the more recent highs, and we've got a fair bit to go still to be able to get back up to record highs, but we are travelling in the right direction. There's still a few hurdles for us to be able to go over. There's small matters like the US election and the disputes that so everyone seems to be happening with China at the moment. The earnings season, that basically finished up at the end of August, early September, and as you would have expected, fewer companies produced a profit over the last 12-month period of time. That means that fewer companies have been able to pay out dividends. The good news is they've held on to the money, so the cash position of Australian companies is in very, very good shape. So once we get through this period of time, we get to more normal circumstances, Australian companies are in very, very good shape. Company balance sheets are very, very strong and very much cashed up, ready to spend when the all clear is given. And that indeed certainly supports our outlook for the share market, that we continue to see expectations of a recovery. Well, I've got 3 slides to go. A lot of people like to know that, particularly the organisers. They look at their watch and they say, hold on, you should be finished pretty close. Well, so give me another couple of minutes and I will be finished. Let's talk about interest rates. This is generally a pretty boring topic because not much has happened for some point in time. But some of the major banks have got a little bit excited over the last couple of days, saying the next Reserve Bank board meeting on October the 6th, that the Reserve Bank is going to cut interest rates. Now, you might say, well, what could they cut it to? The expectation is we see a rate cut from 25 basis points or 0.25% to 10 basis points. A lot of people say, well, that's nice, but what sort of good is that going to do? Well, that's our sentiment exactly. We don't think the Reserve Bank should be cutting interest rates at this current time, and there's not really the need to cut interest rates at the moment. If you look at some of the things like our spending levels, our housing level, the home prices, the overall economy, we're actually working through this quite nicely. So I can't see the reason for the Reserve Bank to be cutting interest rates at this point in time, but we'll see for certain once we get up to October the 6th. One thing is clear, the Reserve Bank Governor has made it very, very clear that interest rates are going nowhere for the next 3 years. So you can bank on super low interest rates for a long period of time. Bad news if you're a saver means that you've got to continue to work hard and speak to people like the Partners Wealth Group, and so get their good advice, you're able to see what you should be doing with your money in the current period of time. Overall, we are seeing one of the biggest contractions that we've ever seen in the global economy since the end of the Second World period. But central banks, governments haven't been sitting on their hands. They've put a massive amount of stimulus into the system. Now, a lot of you will say, yeah, that's fine, but what about debt? Isn't debt going to blow out and we're going to pay that back over time? And certainly, yeah, that is the case. If we're borrowing a lot of more money, we're spending a lot more money, we're going to have to pay that back over time. But what has the Reserve Bank Governor said? What has the Federal Reserve Chair actually said? Said, well, there will be a time when we do have to focus on paying back that debt, but that time is not now. What we need to be focusing on now is being able to get our way through the situation and get out to the other side. The other things that I wanted to highlight is the fact that confidence and jobs are 2 of the most vital ingredients. So if you're looking for indicators of the economy, watch the weekly reading of consumer confidence, look at the latest job figures. because they're all important in terms of how we get out of the situation, how quickly we get out of the situation, and who is actually going to be affected by them. The other things to focus on is things like US-China trade situation. That hasn't gone away. It's still around the place. And the US election. Yes, that small matter is around the place. Donald Trump versus Joe Biden. It'll be interesting to see the way that plays out. We at CommSec have done a paper on the US election only over the last couple of days. So if you go to the CommSec website, you'll see that represented up there. Well, I think that's a bit the end of it for me. Oh, one more thing I want to put up on the screen. Some of you are interested in facts and figures. So here's the economic forecast. Here's our forecast for economic growth, for inflation, for the unemployment rate, what we think the share market's going to do over time, and also the Australian dollar. So I'll leave that with you to be able to mull over time. But overall, we have been getting more and more positive in terms of the economy, basically because of our success in keeping COVID constrained, and certainly about the commitment by state, territory governments and the Reserve Bank in providing stimulus to the economy. So I'll leave it at that, and I think we may or may not have some questions.
Thank you, Craig. Really appreciate that insights there. We will have some time for some questions. I would encourage everyone, please, to type in questions into the chat part of the WebEx. I want to start with the first question for you, and this is in relation to debt. It said, your summary slides show debt versus GDP for Australia and other developed economies. In comparison to other developing economies, Australia seems to be okay. Does CommSec have modelling of what they believe government debt will peak at in dollar terms or as a percentage of GDP? And should we be concerned with this?
As a proportion of GDP, yes, so I should have. Are you still seeing my slides on the screen or not?
Oh, we are. We can see the first page, yep. So we could go to slide 20, I think. We're at 50%, I think.
So there, that tells you where we are at the moment. So in terms of debt to GDP, the last financial year that we've just finished, Australia had a debt to GDP ratio of 25%. So that's a net debt ratio. The gross debt ratio was around about 35%. So you can see that represented on the screen there. What we're likely to see is net debt rising to something like 35% and gross debt increasing to something like 45% of GDP. Where's Japan? It's something like 230% of GDP is the gross debt ratio. Italy's up around about 150%. The United States is sitting around about 100%, together with the likes of France and Canada, and United Kingdom's not far behind. So we went into this crisis in good shape. Our budget was basically balanced, and we had a very low level of debt. Now, perhaps we could do even better in New Zealand. New Zealand always seems to beat us, don't they? Particularly things like Bledisloe Clubs and the like. But we are amongst, in terms of major economies around the globe, we have got a very low level of debt. So that's the expectation. The expectation is that our debt's not going to blow out. It is quite manageable. And remember the other thing about debt, if you're paying off a loan, what's very, very important in terms of that is the interest rate you're paying on debt. If we're looking at, so the interest rates at the moment, they're close to zero. So our debt servicing is very, very modest compared with what we've seen in the past.
Thanks, Craig. The next question is, thanks for your presentation, Craig. It was very insightful and does provide some optimism. The Australian currency was predicted recently to go to 80 cents US dollar. It has come off in recent weeks. Any predictions on where the dollar will be in 12 months' time, or a general view?
Well, currency gurus, there's the slide in front of you. So it's nice to be able to be asked questions and actually have an answer. Yes, here's the answer there. And these are from our currency gurus in Commonwealth Bank. They do believe that the currency will appreciate modestly over time. The expectation is that we will start to see progress in things like vaccines and treatments, that the second waves will end and we'll start to move out of this lockdown period of time, and we'll see reopenings modest and slow and staggered lifting in terms of international or easing of international borders. Once the global economy starts bouncing back, more spending by governments, particularly in terms of infrastructure and the like, that means greater demand for things like iron ore, for coal, for our gas and other resources here in Australia. Very much benefits the Western Australian economy. the expectation is with stronger global growth and domestic growth that will lead to a higher Australian dollar. So that's our expectation. That's what we've built in at the moment. But certainly over the last couple of days, the Aussie has softened rather than weakened, against a stronger greenback. What we've said, as I say, a weakening of the Australian dollar in recent times. But our view is that once we look out into the end of this year and into 2021, that we'll see a modest appreciation. And as I say, the major driver being an improvement yesterday in the global economy and the demand for our key commodities.
Thanks, Craig. Next question is from Lyndon, who's got a question in relation to franking credits. Thank you for your seminar. We mentioned the benefits of franking credits. Given the level of debt we will finish up with at the end of all the federal stimulus, can you see any likelihood of a future government having the courage to revisit the issue of franking credits to help paying back the debt?
Short answer, no. We saw what happened to an opposition that tried to take government and make some suggestions in terms of this. Clearly, Albo doesn't want to go down that route, and the approach by the federal government, and I think also by state and territory governments, is that we don't want to be looking at things like tax increases. We don't want to be thinking about that much too early. What we want to see is, in terms of turning around our budget situation, is to get the economy growing faster. So if we can get the economy growing faster, we can get more people into jobs. That creates the momentum to be able to pay off this debt over time. You've got to remember too that things like JobKeeper and JobSeeker are very much temporary measures. They won't be around the place in 12 months' time, so they won't be adding to our budget situation. So we can get some faster growth, and we can get out of this lockdown period and start to see a reopening of global borders. Then we will start to see an improvement in terms of our budget bottom line. But the way to achieve better outcomes in terms of the budget is not by increasing taxes, because that just slows the economy down and robs momentum of the economy.
Thanks, Craig. The next question is from Ben from Perth. With rental vacancies at 1.6% in Perth and renters now queuing to lodge rental applications, there's noticing a shortage of rentals. Do you think this is a short-term rebalance, or there's a greater movement of people and immigration coming to Perth? I know the border is shut at the moment.
Well, we have seen the population figures. The population figures came out yesterday, and what it showed is that we're seeing some of the fastest growth in Western Australian population that we've seen in the order of 6 or 7 years. So population growth has picked up. The economy is improving, particularly demand for gold, for iron ore, for all the rare earths and the like. A whole range of mining demand is being supported by other parts of the world, particularly by China, and prices are holding up very, very nicely as well. So certainly Western Australian economy has performed very well in this period of lockdown. But if usually what happens in terms of housing, you either go too far with producing too many homes, then when you pull back, you produce too few homes, and you've got to play catch up. So we're constantly playing catch up with the markets. Either supply is running ahead of demand too much, or demand's running ahead of supply. To be able to get that nice nirvana balance, it would be perfect, but in the real world that tends not to happen. So what we are seeing is strong demand for properties, at the moment. That will put upward pressure on rents and upward pressure on home prices. And the response to that, the economic response, is that we'll get more builders, more developers recognising the potential to be able to do work in this sort of environment. There's also the home package from the Western Australian government, and there's also a home builder from the federal government that will provide some support for more homes being built in Western Australia as well.
Okay, thanks, Craig. The next question cast out overseas to the US, and it's in relation to what impact would a Biden win have on both the US and local share markets in November if Biden was to win the US election?
There's a number of permutations and combinations, because it's not just as easy as saying if Biden wins what happens, or if Trump wins what happens. We also need to work out what happens to the composition of Senate. So if Biden was to win and the Democrats were basically to take over the full Congress, that would be seen as negative by the share market. So we would be seeing some sort of short-term correction there. If Trump was to win, but perhaps not get the majority across the Congress, again, sort of the situation would be probably more of the same that we're seeing over the last 2 years. If Biden was to win and not get control over Congress, I think the share market would be basically more wait and see rather than anything else. But the concern is from Joe Biden that so he tends to favour some tax measures, things like capital gains tax, and clearly that's some negative in terms of the share market. So it is potentially going to be a very volatile time. As I say, we have done a report recently in terms of the US election and the impact on markets like the share market as well as the currency markets. So get a copy of that report to be able to go through some of the permutations in a little bit more detail.
Thank you, Craig. The next question is from Heath, and he was just asking in relation to if you believe there'll be any additional stimulus are we expecting for the residential construction industry?
I don't think so, but I think it's the case in the current environment that federal, state, sort of governments, territory governments, they're not going to close the door. They're not going to say no to these sorts of things. They're going to continue to look at the situation and be able to determine what should occur over time. So if we had a situation, particularly as we go into 2021, where the downturn in terms of overseas migration could have a bigger impact, so that if it does look as though the lack of demand for homes compared with the supply is leading to a very significant fall in terms of home prices, then the federal, state and territory governments will relook at the situation. So I think it's not a case of never saying never. If the need is there to be able to keep our economy moving forward, then so that the governments will do whatever it takes. So certainly interest rates are low enough. We can't really go much lower. The discussion about negative interest rates probably won't go away. Our view is that we won't see negative interest rates in Australia. It actually creates more problems rather than it creates opportunities or growth for the economy. It's been tried in places like Europe and Japan. You can't say it's been a stunning success in either of those places. The United States has ruled it out. The UK has kept an open mind together with New Zealand, but our view is that rates are basically as low as they need to be and as low as practically possible. So if we need to see any further assistance for sectors for the economy, it's likely to come through fiscal measures rather than anything else.
Okay, thanks, Craig. The next question is from Nick in relation to the property market, which I think is everyone holds dear to their hearts. With the stage 4 restrictions in Melbourne stretching up to 12 to 16 weeks, people in financial distress will have been unable to sell their property assets. With banks starting to wind back mortgage holidays, does the CBA forecast a rise in distressed asset sales and a flow-on impact on prices?
It's a watching brief. Certainly, we'll be watching on a case-by-case basis. Each of the individual banks will be looking at very, very closely at this on a state-by-state basis. But remember, in terms of the rest of Australia, we had the mortgage holidays. We came out of the lockdown period and a sense of normality sort of returned. Well, what we haven't seen in places like Sydney or Brisbane, even sort of Perth, we haven't seen a tremendous surge of stock coming onto the market. So we haven't seen, and as I say, one of the key reasons for that is that interest rates are super low. There has been an extension of, if it's not mortgage holidays, it may be an extension of the term of your loan to be able to help you through this situation. We've also had the announcement today that responsible lending laws are likely to be changed federally. That's why the share market's up close to 100 points today, or so getting towards sort of 2%, because the banks are off to the races. So that will come into it as well. A reduce, well, not more lax, but some reduction in terms of lending sort of criteria may provide some assistance more generally in terms of borrowers, but specifically in terms of the housing market. So that news has just come out today, and that's going to provide a degree of support. So it will be something that the state government in Victoria, as well as the federal government, look at very, very carefully. But a lot of people were already way ahead in terms of their mortgage repayments, and as I say, super low interest rates helping people, as well. It gets down to jobs, really. If people, can come out of hibernation and reconnect with their employer, and so get back into the job market and start to earn their income again, then so clearly there isn't the need for any forced selling. So employment, it is vital to the outlook for the housing market and the outlook generally for the economy.
Okay, thanks, Craig. Thank you everyone for sending through your questions. We're on time now, and I'm conscious that everyone has things on. So just wanted to thank you, Craig, for your presentation. Really insightful. It does give us hope for optimism, given the position Australia is in, and hopefully we don't we come out of this and don't go back into a third lockdown. Also wanted to thank all the attendees today. Appreciate you coming into this WebEx. If anything today has sparked your interest, we're offering complimentary meetings with an advisor to go through, sit down and look through your financial position. We've got no doubt that at least 2 or 3 of those strategies that we ran through today would be relevant to people attending today. There's plenty more strategies that we have that can incorporate to solve that issue around us living longer and retired for longer with the limited capital. So thank you again for your attendance. We will be sending copies of the slides to everybody, a copy of Craig's slides and my slides. If you have any questions around that, please contact your accountant. Thank you for your support, and please stay safe, and look forward to communicating again with you. Thank you very much. Thanks, Craig.
Bye-bye all.